In today's video and podcast, I'm going to explain to you why not looking at your account balance can be really beneficial to your Forex trading results. Let me share more details with you right now. Hi traders, it's Andrew Mitchem here from the Forex Trading Coach, and today is non-farm payroll day. It's the Friday, the 3rd of October, so be really careful with your trading into the US session today with that US job employment data news coming out later. But the main point that I want to cover on today's video and podcast is why I think it's really beneficial and how it can help you with your trading, with the emotional aspect of your trading and the psychology behind trading by not looking at your account balance when you're taking trades. Now, what I mean by that is a couple of things depending on which side you are. If you have a relatively small account, it becomes really quite easy and distracting in that a lot of people like to take too big a risk. You know, they say, well, I've only got $1,000, it doesn't matter if I lose it, therefore I'm going to take X amount of risk. And it might be something, they might be risking, let's say, $100 on a particular trade. Now, if you're doing that, you're actually risking, of course, 10% of your account, which is far too much. So rather than doing that, I think it's far more beneficial to forget what your account size is right now and look at trading an equal amount of risk per trade and having controlled low risk. That's the important thing. So when I'm trading myself, I trade at no more than 0.5%, so half of 1% of my account risk on any one trade. That's the maximum I can lose. I know that in advance, so it doesn't matter what the currency pair is, what the type of trade is, what the time frame of the trade is, whether it's a reversal, continuation, or it's a breakout, whatever it is, it doesn't matter how many pips the trade is risking. And if it loses, it doesn't matter how many pips the trade loses, because I know I have a set amount of risk, an equal amount of risk on every single one of my trades. And that really helps you with the understanding, the psychology, the emotions of your trading. Take it to the other extreme. If you've got a large account, let's say you had a $1 million account. The trouble is when you're looking at your account balance all the time is that the emotions come into it in a different way, and it makes you hesitant. It makes you really, well, do I take the trade? Should I close the trade early? You know, you become really hesitant because you see your account going up in hundreds or thousands of dollars up and down all the time. And it's very easy to want to take the trade in terms of taking the profit slightly early or meddling with the trade too much. Whereas if you know you have a set amount risked on that trade, again, half of 1%, then you become comfortable with the trade because you're not looking at the dollars or the pounds or the yen, whatever your account's in. You're not looking at the amount you're making. You're looking at the percentage that you risk as opposed to the percentage that you make on a trade. And it's a far better way of trading. It takes all the emotion out of your trading. So that's a really important point there. In terms of percentages, well, I had a live webinar, a 2.5-hour live webinar with my clients last night. I had a client who's been with me for just over 3 years now. He lives in Canada. His name's Bo, and he reported that last week he made 6.15% on his account just in the 1 week by trading 15-minute charts and I believe also a few 1-hour charts. So just a fantastic result. Of course, that doesn't happen all the time, but it shows what can be achieved. I took 5 trades last night on the 1-hour charts. I had 3 winning trades and 2 losing trades. The winning trades averaged a 2.2 to 1 reward to risk. And so therefore, that meant with 0.5% risk on each of those 5 trades, I made a total of 2.3% on my account. So it's a pretty good return when you consider they were just 1-hour chart trades, and I effectively lost 40% of those trades that I took, but still made a 2.3% return with only a 0.5% risk on each of those trades. So very low risk, fantastic reward to risk ratios. In other words, making a lot more than I'm risking and ending up with a fantastic account percentage return just on one live webinar over 2.5 hours. So really pleased with that. The other thing I was really pleased about was the performance that a lot of my clients were reporting in, trades that have taken over the past couple of weeks on all sorts of time frames. People were talking about hourly time frames right through to monthly time frames and everything in between. And it's just really exciting when people are taking good trades and gaining fantastic results on their account. So really pleased with that. So overall, the lesson, I suppose, the point to take from this video and podcast is to forget making pips. Forget that. Have controlled risk on each trade. Don't look at your account balance. Look at having controlled risk, high reward to risk trades, and also the important thing that most of my clients were reporting yesterday, the ones that had profitable trades, was they were taking their trades on a variety of different time frames. If you can, don't just trade one time frame. Look to trade multiple time frames. To give you an example, I've had a fairly average week this week on my daily charts, yet my 12-hour charts have been tremendous and my 4-hour charts have been tremendous. So it just shows by having a variety of time frames. If you have a losing week or a lesser quality week on one time frame, you generally find that if you trade 2 or 3 or 4 time frame charts, you can make up for those losses, plus a lot more by having profitable trades elsewhere. So that's it for this week. This is Andrew Mitchem from the Forex Trading Coach. Have a great weekend. I look forward to talking to you this time next week. Bye for now.